Coming up today, stocks start the week firmly higher as Wall Street update their price target, a look at market fundamentals and market internals, and a preview of what to expect this week. Hey, what's up guys? Welcome back to the daily market review for this shortened trading week. We're shut this Wednesday while America observes the Juneteenth holiday on the 19th of June every year. And what a strong start to the week we've got here, led by tech again. Mega cap tech doing all the heavy lifting. And just looking at the S&P 500, ever since Jay Powell and Janet Yellen came out on the 1st of May, Jay Powell reduced his quantitative tightening program. Janet Yellen also helped to backstop the market with treasury liquidity, short-term bond buying. We ripped right up, put in this big bearish engulfing candle, peeled back a few days, then did this big buy the dip strong hammer candle, and once again we've ripped right back up here to fresh all-time highs today, now approaching 5,500 on the S&P. Still a little mixed overall in market color. As we all know, market breadth has been quite weak of late, but we've also still got bond yields downtrending. A little bit of improvement in breadth today with the Russell 2000 also finishing up. Bit of an uptick in volume breadth, short-term breadth just holding in there. However, we've still got the amount of stocks breaking down to new lows, outpacing that of new highs. Volatility still relatively low here, under 13. Volatility risk premium still in about mid-range level. Implied correlation super low. Along with the put call index, there's a 2-year bumping up a bit today to 477. Along with a little bump up in the 10-year. High yield bonds still sitting pretty above the 50-day VWAP. Bitcoin flatlining, along with gold. Bit of a pop up there for crude oil today. And the strong gets stronger. Look at that with Apple. Up almost 2% today, again on big volume. Price action's gone crazy this last week in Apple after their Worldwide Developers Conference. Wall Street seems to really be buying into this and expecting they're going to start growing again soon. Also got Microsoft hitting a brand new all-time high today, but just like I was saying on Friday night, starting to look a little stretched here in the short term. NVDA, once again, getting within a whisker of becoming the world's biggest company early this morning in trading. However, peeled back into the close, finished down slightly, and nice bounce back for Tesla there as well. Putting it all together, what are we thinking? Well, an extension of Friday, pretty similar thoughts. A little stretched here in the short term. Now got the third consecutive reversal signal firing off into technically overbought territory. However, the trend strength is quickly getting back to blue, which means the market will be showing some persistent trend and momentum. And so quite often when you'll see persistent short-term overbought conditions, that can lend itself to really strong medium-term momentum and trending. So the more we stay overbought here in the short term, the better that bodes well for the medium term and for the rest of the year. And the more likely the short-term overbought conditions will just turn into some consolidation instead of a sharp pullback and dive. Everybody's been talking about the waning breadth in the market, and if Nvidia rolls over, then the rest of the market's going to roll over with it. However, that's becoming pretty big consensus out there now. So it may be just a case of Nvidia pausing, rolling over, and the rest of the market, small caps, could actually do some catching up. And so we still have a lot of bullish signals out there. And since we've done so well right out the gate, now sitting at the halfway mark through this year, now getting Wall Street analysts and investment banks increasing their end-of-year price target on the S&P, one after the other now. We even got some mega bulls out there calling for Dow Jones 100,000 on a turbo booster combo of earnings growth and Fed rate cut. That's Main Street Research Chief Investment Officer James Dermott said investors should overweight technology stocks on a continued AI boom. And there's a look at a long-term monthly chart of the Dow Jones Industrial Average, just sitting a little bit below all-time highs at 38,778. So that investment officer is very bullish, calling for 100,000 on the Dow before this cycle's out. Just as bullish is always Wedbush, saying Microsoft stock will surge 24% amid a tidal wave of AI monetization opportunities, lifting their price target to $550 on the backs of growing bullishness towards their AI Copilot software. And the firm's cloud platform Azure also boosting AI spending. And it's true, I can see myself as a heavy user of online tools and these big companies, Google, Microsoft, not only incorporating AI all throughout their own companies and back office, but also into their products, existing and new. And here's a look at the sales page for Microsoft's Copilot product, allowing you to complete small tasks quickly, working alongside all your favorite apps, Teams, Word, Outlook, PowerPoint, Excel, and they are definitely resulting in productivity gains for the individuals and companies that are using it. And there's a look at Google's Gemini Advanced, their AI chatbot. Real simple sales page, and all these little add-on services they're doing. Such high margin, really scalable across their huge installed user base, got those network effects. And so the fundamentals are definitely there on the companies and earnings growth and momentum. That's why Wedbush has got a price target on Microsoft of $550, which it very well could hit in the next 6 to 12 months. And it isn't just big mega cap tech. we've got earnings growth broadening out to the rest of the market, and just looking at earnings surprises over the last 4 quarters, coming in a lot better than consensus. Here in the green diamonds, we can see that corporate earnings recession that finished middle last year, we've gotten back to growth. The consensus for the rest of this year and into 25 is increasing again. So if the market were to come out on top of consensus, then that's a very strong tailwind for higher prices. Not only that, we've got confidence among CEOs bouncing back above the 50 level, indicating most of them are positive, well off the lows from just a bit over a year ago. Not only do we have growing earnings, confident CEOs, we've also got cash spending increasing by 9% this year, with mergers and acquisition spending increasing by 15% and buybacks by 13%, set to hit a record this year above $1 trillion. In corporate capex, almost $1 trillion in buybacks, $658 billion in dividends, $637 in research and development, and $442 billion for cash acquisitions. All 5 key areas increasing year over year. Again, supportive of the stock market. And that's been an interesting long-term trend, and it's probably added to this huge secular bull market we've had in equities since March 2009. Just looking at the share of total S&P 500 cash use. In the dark blue is capital expenditure, research and development. Back in the early 90s, was above 70%. Here we are around 45%. At the same time, buybacks and dividends around 25% in the early 90s. Here we are expected this year to come in at 43%. So in other words, American companies have become more efficient in producing profit. They've had to spend less capital, less research and development in order to make more profits, and been able to use that excess cash to buy back shares and send some of those profits back to shareholders in the form of dividends. Again, supportive of the stock market. But are we getting too ahead of ourselves here? Just looking at presidential election year seasonality. In the dark blue line here, where we are now, on average, for a presidential election year, stock market's only up about 3% and often goes on to finish up a bit over 10%. Here we are now approaching 14% performance year to date, maybe getting a little ahead of ourselves. And looking back in history, when we go too hard too early, can set up for a pretty soft and weak rest of the year. And just looking at what type of strategies are performing well so far this year. Momentum well out in front, then multi-factor size. Coming down the bottom, short interest. Stocks that have high short interest have been going the opposite way to what they normally do, looking at long-short strategies. And of course, also performing weak is value and dividends. In addition to value and dividends, what I also identified on Friday's show was small caps, looking at the big divergence, not only technically but fundamentally with valuations between small caps and large caps. And typically, June is a positive month for the Russell 2000 small cap ETF. In fact, over the last 10 years, only June it finished down was back in the bear market in 2022. Every other year, it's finished the month higher with a 10-year average of 2.1%. And so far, for the month of June, IWM still down more than 2.5% from where we started. And if it were to follow 10-year seasonality, then we should be finishing somewhere around $210 on the IWM ETF, which is a bit over 5% higher than where we are now if small caps were going to bounce back this month. It's not only small caps diverging big time from the market, it's also dividend aristocrats, those that consistently grow their dividends every year over the long term. And there's a look at one of the most popular and well-traded dividend growth ETFs, DGRO, also finishing higher today. However, just looking at a spread chart of DGRO to S&P 500, very oversold here on the daily chart, third consecutive reversal signal, and also on the long-term monthly chart, dividend growing stocks, deeply oversold versus S&P 500. In fact, the spread is down more than 20% over the last 18 months, potentially suggesting dividend growth stocks here are cheap. At least technically speaking, they most certainly are. So the stock market's doing well, hitting new highs, Wall Street expectations jumping up, large company profits, all-time records. That translates into consumers feeling a lot better, right? Not so much. Real household income expectations nosediving these last couple of months, now down at the same levels from the global financial crisis into 2011. The economy was very soft during that period. So that's inflation-adjusted expectations. Consumers, even though we're getting nice looking headlines on inflation, disinflation, government telling us it's 0% month over month, things like that, according to consumers, they're still feeling the pinch. Now let's keep in mind, we're still months out from what's most likely going to be one of the most hotly contested US federal presidential elections of our lifetime. And even on a good presidential election year, the VIX on average will still increase by 25% from July to November. And believe it or not, we've still got a bear out there. Probably one of the most famous last standing bears on the street. JP Morgan's Marko Klanovic still expects the S&P 500 to fall 23% by the end of this year, going against some really strong seasonality. The will of all levels of government, corporate earnings, buybacks, you name it. He's really sticking his neck out there, saying his cautious stance has been based on our view that there is no re-rating upside, and that any upside had to therefore come from earnings growth, which we see being insufficient to take on equity risk even under best case scenario assumptions. Said S&P earnings per share will only be $225 this year, compared to average Wall Street forecast of $240. However, like him, Wall Street appears to also be ignoring the strength of the consumer, which has been showing signs of softening along with their expectations, and the jobs market softening as well. Get another look tomorrow at retail sales, with the last report coming in below expectation, causing some sharp pullbacks in retailers. Still got a select few retailers though, and other consumer discretionary stocks doing well. And just looking at what Goldman Sachs is forecasting for tomorrow, they're actually saying we're going to get a rebound in sales growth for the month of May to 0.3%, headline 0.5% on the core. Going on to say they think the outlook for consumer spending remains solid. And just moving on today to a story we've been covering lately, GameStop just finished their annual shareholders meeting, which had been rescheduled after last week. Too many people showed up to the webcast and it crashed. Shareholders were really interested to know, what's Ryan Cohen going to do with all that cash he's got now to play with? Just reiterated their past statements, cost-cutting plans, said he's focused on creating a smaller network of stores. Their strong balance sheet provides it with a strategic advantage. Said we're not here to make promises, we're here to work. Didn't really unveil any big new bold growth plan, potential acquisition, new categories they want to enter, getting into Bitcoin. I mean, they got $4 billion on the balance sheet. They've got to really leverage that into some new business, or at least get investors excited, keep the valuation lofty, maybe do another secondary down the track. However, for today, investors not too excited about what they heard, marking down the stock 12% and a bit below where GameStop was able to sell 75 million shares, 28.49. And barring any unforeseen surprise, sharp market pullback, one would assume that it stays above their first share offering back in May, which went through at 20.74. But we'll keep an eye on that along with other important stocks this week. And just to get you updated with what's happening next week, retail sales tomorrow, used vehicles, treasury flows. Wednesday we get housing data and the market's shut for Juneteenth. Thursday, Philly Fed business outlook, and then finishing Friday with some PMI. And there's a look at what we're expecting tomorrow with retail sales. Year-over-year growth 2.8%, month-over-month 0.2%. Fed Fund futures still pricing in about 62% chance we cut in September. Fear and greed index in the fear zone as the S&P and Nasdaq rips to all-time highs. What's going to happen if this goes back into the greed zone? Corporate insiders not doing a whole lot of trading either. Typically things will quiet down going into the warmer months. And there's a look at TLT pulling back today, but still holding well above this downtrend line that it broke above. A little bit of a bump up in China stocks to start the week. Clean energy pulling back a bit here underneath the 50-day. Winning sector today was consumer discretionary and the losing sector biotech. And a bit of a bounce back in the financials there today. All right, guys, that's a wrap for Monday's review. Pretty bullish start for the week. Not a whole lot on the economic or corporate calendar. And like I said, we're starting to look a little stretched here in the short term. However, that price action, especially the longer we stay in this overbought territory, just creates kind of a firmness in the medium term and for the rest of the year. Thanks very much for tuning in, and we'll see what tomorrow brings us. Cheers.